Fabulous. We're recording. So we thank you everyone for coming today. I expect, as I said, that we'll have about 12 to 15 people or so by the time we get cracking. Usually people kind of straggle in over the first couple of minutes. And then the recording, of course, will be seen by quite a few of you, and no doubt questions will come. Today, I am thrilled to be joined by, first of all, a personal friend, and the best type of friend. Not only is he someone who I respect immensely as a person, but he is also someone who I've had the pleasure of working at in my previous job, where he actually headed up our mortgage division. One of the reasons, and I'm going to let Chris just do a brief introduction for himself before we set what it is we're going to do today. Hopefully this whole spiel from me and him will take 2 minutes, and then we'll cut right into the meat of things. But the be-all and end-all is this. There are only a few people who I trust in the mortgage world. I can probably name them on a hand. Many of them are part of our site, by the way. Denise, Andrea, Bart, certainly Sean and Elon. But amongst those people, oh look, Bart just joined us. Bart, I was just saying you're a trusted mortgage guy. But certainly of the people who I can count on a single hand, who I trust unequivocally about mortgage advice and being able to pull through deals, Chris is high amongst them. I know Chris for his integrity. I know Chris for his acumen. And I am thrilled to actually be able to have a conversation with him today. And again, Chris, I'm sorry, I'm taking one more second. Before I actually start with Chris, I want to tell you that the purpose of today is not a question and answer session. The purpose of today is to discuss what we are feeling is happening in the market. A lot of the questions I'm going to ask, a lot of the things we may choose to talk about might not have discernible answers, but we're going to give you our feelings as to what's been happening. I intend to speak about it, seeing it through the eyes of a lawyer. Chris intends to speak about it through the eyes of an agent. And hopefully we can together get a good semblance of what's taking place in the market, which is incredibly useful for all of us. I see a lot of people have joined. So I'm going to turn this over. Chris, please introduce yourself for like a minute or less, because I've taken up all your time. And then we're going to get right into conversation, which anyone is free to add to, given that we now have about 10 people in on the conversation. Just raise your hand. That would be great. And then just please feel free to go ahead once we just call on you and just join in. Go ahead, Chris.
Great. Thanks very much, Mark. I wish I could have an introduction like that everywhere I went. But I do appreciate you having me on the call with you, and I look forward to our conversation. By way of brief introduction, my name is Chris Mulder. I'm the principal broker of Tridac Mortgage and vice president of lending for private mortgage fund Hands Up Mortgage Investment Corporation. To summarize what it is that I do in its simplest form, I connect people who need money with people who have money. That's simply put what I do as a mortgage broker. For me, this is a family business. My father started the brokerage back in 1977, and we operate from our brokerage on the Danforth. And so my real passion is to help people solve hard money problems and guide all the stakeholders in the entire process to have a positive experience and a successful mortgage financing in whatever way, shape, or form that is, from first-time home buyer to reverse mortgages at the end of life. So we find all these different solutions using the different toolkits that we have. And I'm very pleased to be on this call with you, Mark. So I'll let you take over and ask away.
Awesome. So guys, we're going to try to make this purposeful, and we're going to try to make this challenging for us and for you, because we don't want to just have a simple discussion about, you know, what is LTV, what is whatever it is. We are assuming you guys are professionals and you have the same desire to know what's happening in the market in the state of COVID that we do. So I'm going to ask a couple of questions. I'm going to be very cognizant of the fact that some of the questions and discussions that I'm going to be having with Chris are in fact commercially oriented. And Chris is not a commercial mortgage agent, so he knows possibly as much as I do in some of the questions I'm going to be asking, but nonetheless they're relevant, and perhaps we can figure this through just in discussion. So one of the questions that I had personally this week is something that actually happened for the first time, Chris, and you'd be in a good position to actually answer it.
Mhm.
So like so many of us, someone lost their job with COVID. They owned they were part of a restaurant. The restaurants are shut down. By the way, restaurants are
Mhm.
hit particularly hard. They're probably the ones that are not going to recover from COVID more than anything else. And their mortgage is due. Their mortgage is due, and the lender is sitting there saying, "Give me 2 weeks of payroll." And while they have 2 weeks, they're not going to have next week's. And it brought up a very simple question: what happens if you lose your job as a result of COVID and you are in a refinancing mode, or if you're at a refinancing time? What actually happens there? I actually don't know the answer to that.
Yeah, yeah, it's a good question and a very real issue for a lot of Canadians. So I think we need to divide this discussion between two different types of mortgages, whether we're talking commercial or residential. And we'll start with residential because that is easiest. So if if there was a pending mortgage application before March 24th, I believe that was the cutoff date, and income had been approved by the lender, and let's say is for a purchase or refinance, doesn't matter what the transaction is, and your closing was subsequent to that date, but your income had been confirmed, and then after that date, you were temporarily laid off, then mortgage lenders are making special considerations, which is absolutely unprecedented, to actually fund a mortgage to somebody who may not be in a position to pay it back. So we have to distinguish this conversation between different types of scenarios. So if you had a pending application, your income was approved, you lost your job, the mortgage will still move forward. If you're making a new application today for refinance or purchase and you've lost your job, then that is not going to sit well with the lender, and the possibility of a successful application is slim to none until you return to work. Now, when it comes to renewals of mortgages, as long as you're keeping status quo with your current lender, the renewal will happen without requalification. So if you've lost your job, and let's say on May 1st, June 1st, July 1st, your mortgage comes up for maturity and renewal, and you've lost your job, the lender will simply offer you a renewal without the need to requalify.
And is that
Okay?
true?
So
Is that true?
yeah.
Sorry, just to interrupt. Is that also true if you've chosen to defer under their programs? Like, in other words, you're still up to date, but you've made your deferrals of 6 months. Is that indeed accurate as well?
Yeah, that I've asked lenders that question, and the responses that I've received is that the deferrals should not be held against the borrower for renewal, and also in terms of reporting to the credit agency. So they've coded it a special way in order to make sure that there's still integrity and the ability to renew mortgages to mortgages that are technically in arrears, which is, again, unprecedented. That's not status quo for mortgage lenders. If you're in arrears, there's not a chance they would ever renew. Now, what'll happen on that renewal date is the accrued interest will now be added to the balance of your mortgage, and then your new payments will be based on outstanding balance plus accrued interest, and then you'll have a new monthly payment from there.
Interesting. So I know that you were going to talk about commercial, but can we put that aside for a minute? Because I actually want to ask you a bunch of questions about commercial, which I know, again, I understand you do residential. I get it. I completely get that. But I mainly do residential too, but it's commercial that's really experiencing the hit. So let's put that aside for a minute, because you were mentioning, I guess, what is the capitalization of interest payments if you choose to defer. Right. So just for everyone's knowledge, what's happened out there is that all of the banks, and I think you all know this, but there's quite a few of you on right now, all of the banks presently allow for you to defer your principal and interest components of your mortgage, allowing you to pay nothing on your mortgage during up to 6 months. And they're doing that as a matter of course. I mean, to my mind, Chris, and you can tell me if I'm wrong, it's because the banks are evil geniuses. And what they've basically determined is that for very little relative to the mortgage amounts, they're able to increase the mortgage amount and put this debt load on Canadians long term, this doesn't hurt them. It actually helps them. And I was wondering, Chris, if you've heard of anything out there that might actually be a good system of, if you are in trouble, if you need to employ this, is there a better way of doing it than the way the bank's set up? P.S. I usually find that there are better ways of doing things than the way the bank's set up.
Yeah, absolutely, Mark. So couple of comments on it. Depending on your lender, there are different arrangements. The banks have highly publicized the 6-month deferral, but if you have a mortgage with a monoline lender, and monoline lenders are a fancy word that we use for specific type of mortgage lender that only does mortgage financing as their main line of business. Monoline, one line, main line of business. So those lenders, the biggest ones in Canada, include names like MCAP, First National, Merix, Lendwise, RFA. Those are the biggest names, and there are many. So if you have a mortgage with them, they're actually allowing you to manage your mortgage month by month, doing a skip a payment on your own terms rather than deferring the full 6 months.
Oh,
so just a comment on that. Yeah.
So what you're saying is, like, some monolines will basically say, hey, you can put down what you want effectively towards the mortgage, and that amount could even be, say the interest that would theoretically be capitalized at the end of the mortgage.
Correct. But if we're taking a view of 10,000 feet in this discussion about deferral, number one, I think this has been beaten to death already. But at first, there was a sentiment that this was mortgage holiday or a mortgage forgiveness, an interest forgiveness program, which it is not. You've already highlighted this. So what happens is, if you do not pay your interest on that particular month, it gets accrued and added to the balance of your mortgage. So using a simple example, if you have a $2,000 a month mortgage payment, maybe 50% of it is interest, that's $1,000. So now after 1 month of non-payment, $1,000 goes to your principal balance, and that continues for 6 months. So you might end up with a balance of $6,000 more than what you started. And in my opinion, the lenders should have given borrowers a more practical solution than simply mortgage deferral. And to their credit, they reacted quickly to solve problems and help Canadians. But I think a better solution, and if I could give advice to anybody who has deferred payment, it would be to figure out and find out what the interest portion of your payment is. And in an ideal world, you should be making just the interest payment on your mortgage. So rather than taking a full deferral, if you're fortunate enough to have some income, save that interest portion for each monthly payment. Now, the practical solution of paying the interest only portion each month might be difficult, depends on the lender and what prepayment privileges you have. But ideally, you would still make your monthly payment voluntarily, taking advantage of your prepayment privilege, whatever it is, $600 a month, $1,000 a month. You're not paying back your principal, but you're maintaining your balance.
I see. So effectively, then at the end of the mortgage, then you would be in the exact same position as you were at the very instant that you chose to defer. So it's just, there'd be no additional principal that had been paid down, but at the same time, your monthlies would continue. What you're doing is you're effectively extending your amortization rate by 6 months.
Correct. You're freezing things in place without negatively amortizing your mortgage. That's right.
Very interesting. And do you see that people are doing that regularly, or is that something that people are just kind of waking up to?
Yeah, it's something that I'm discussing with my clients who call for deferral. I don't think there's enough being done to advise borrowers in general on how to cope with this. But you have to keep in mind also the context, Mark, of what's happening. The mortgage deferrals that are being offered should really be taken advantage of by those that are most in need. You already talked about restaurant owners, small business owners, anybody who's completely laid off. The reality is, if there's no cash flow coming in, then they may not be in a position, those borrowers won't be in a position to actually defer those, to save the money for those interest payments. However, if there are people who maybe one spouse or one borrower in that arrangement has lost a job, the other does, they're tight on cash flow, and you're looking at how to come out of this the most optimal or efficient way, then there should be an effort made to save at least the interest portion or make at least the interest portion of that payment.
Very interesting, and actually very good advice. Thank you for that, Chris. You know, Chris, I want to have a discussion, you know, as we're talking about refinances. You know, of course, the question of rates are going to come up. And of course, this is what every mortgage broker talks about all the time. And Bart, please feel free. I know you have professional experience in this every single day as well. I don't mean to exclude you from the conversation. If you want to jump in, Bart is, by the way, a mortgage broker with, Cloud, but he's the mortgage broker for Cloud Realty. He has his own business. But you're welcome to come in on this as well, Mark. I'd like to ask about interest rate projections. And I know that interest rates are somewhat intimidating for some people when they try to think of the macro understanding, but the be-all and end-all of interest separate is that it affects more than real estate. It affects our economy generally. It affects what people can borrow money at. And if it is the case that we are going to be digging out of the hole that we've made for ourselves with Corona for the next 2, 3, 4 years, is it a reasonable projection to assume that interest rates will be at historic lows, even more than we've seen, as the government tries to facilitate borrowing so that everyone can actually rebuild over the several years? And I ask this because, you know, the question of variable versus fixed always comes down to where do you think interest rates are going and everything else. I have seen some ludicrously low variable rates. I have just placed a mortgage for 1.5% with Desjardins that have just come in. And I think that speaks to the long-term understanding that banks now have that that money is basically going to be free for a while. Can I get yours or Bart's or anyone else's opinion who knows this area as to what you guys think your projections are?
Yeah, absolutely, Mark. I mean, the bottom line, the macro picture is that we are headed into a prolonged period of low interest rates. Okay, that much is definitely true. However, we have to put a caveat with that, because that type of talk, this type of conversation is very misleading and has been misleading for borrowers and stakeholders in the industry, because while the macro picture is that rates are going to be low in the future, we have a temporary issue, and rates are actually quite high. In your example of giving, the example of a mortgage you recently closed with Desjardins at prime minus, I guess that's prime minus 95. That's dated information. So let me see if I can explain in the simplest way possible what's happening with interest rates, what the mechanisms are. Okay, and we'll divide it into two different conversations, one for fixed and one for variable. So variable rate mortgages are determined by two things. Number one, and most importantly, is the Government of Canada 5-year bond yield. Okay, so that determines the macro direction of fixed rate mortgages. On top of that, and you can Google this, you can look up the 5-year Government of Canada bond yield, and you'll see the direction that the bond yield heads will give us an indication of where fixed rate mortgages are headed. Okay, how the actual rate is determined is there is a spread that banks need on top of the 5-year bond yield, which is determined by something called banker acceptance notes. Okay, so what's happened during the crisis is the Government of Canada 5-year bond yield has hit historic lows. And if the spreads were consistent as they were at the beginning of March, we would expect to see 5-year fixed rate money at less than 2.5%, probably 2.25% to 2%. But what's happened is bankers' acceptance notes, the spreads required for capital have become very, very expensive and increased by 100 basis points.
Interesting.
And so all this is to say that while, as a quick cursory view, without knowing exactly the mechanisms that are happening in the background, we would expect fixed rate mortgages to be at all-time lows today. but they're not, because the spreads required for banks to get their capital have increased, right? It's no different than you and I or anybody on this call during this crisis. What do? You round up the cattle, right? You bring in all your cash, and it's going to be really hard for anybody to part with their cash today.
You know what?
And the same is true of financial markets.
You know what's really interesting about that? So if I may, and tell me if I'm wrong, this isn't my area, but it sounds to me like what you're saying is that the bank, the overnight or 5-year bank spread, is the systemic risk to the system. That's what it's pricing. But the margin that the bank needs to take is the risk on the actual real estate. And what you're saying to me is that the risk on the real estate is increasing while the systemic risk remains low because of government commitment, which is a fascinating sort of development, because real estate has always been seen as one of the most stable of investments. And what you're saying is, as people kind of proceed forward, the interest rate, which is a combination of both government risk plus systemic market risk in the real estate market, it's the real estate portion that is starting to show flux and growth, which means that the market itself is pricing in and saying, hey, things are changing. That's a fascinating sort of development.
Yeah, and that's and it's more macro. I wouldn't characterize it as the spread being determined only by real estate, but it's more of the macro picture of the risks that banks are willing to take on.
Right.
And that includes real estate, right? It includes real estate in there. And so there was a real pullback. I mean, rates really bounced in March, and it was very challenging as a broker to explain to clients, because we had, at the beginning of March 1st, I mean, a 5-year fixed rate was about 2.5%, which was pretty good, right? And this was just the natural interest rate before we were worried about COVID. And then as the lockdown occurred and the economy shut down, there was a slight drop by maybe 10 basis points. And then immediately on March 15th, or whatever the date was, 5-year fixed rate money jumped to 3.25%, which is not what we would expect. Since then, throughout mid-April, rates have started to come down again. Most notably for any realtors on this call, which is a good sign as well, the Government of Canada, the 5-year qualifying rate has come down as well, which is the rate used for the stress test. So that's positive. And the macro is that in the future, as the risk starts to abate and we go back to work and the economy starts producing, we will see the need for that spread to start to drop, and we will see lower 5-year fixed rates in the future. There's no doubt about that.
I'm going to ask a question that I'm going to need you to explain. I think you need to first start by just explaining what the difference between a CMHC mortgage backed mortgages and a non-CMHC insured mortgage is. And I wonder if, given what you've just said there, if there is a difference between a CMHC back, like an under $1 million mortgage, or something which doesn't have that same backing. Is there, in fact, a difference in the spread? Is there, for a non-CMHC backed, is there a larger risk component that is now being priced over and above the CMHC, which of course is backed by the government anyways, and therefore should more closely hew to the 5-year?
Yeah,
you might want to explain what I'm asking, because I don't know.
We've simplified this language for anybody who's listening between, and you might hear this from brokers or on rate sheets, between insured mortgages and uninsured mortgages. And for the last, it's been about 3 years now, since 2016, 2017. I can't remember the exact date, but the government came out with these new rules determining what an insured mortgage is versus uninsured. And just very briefly, uninsured is any mortgage that's for a refinance and any mortgage for the purchase of a home over $1 million. So there has existed a difference in pricing between interest rates for the two different types of transactions. And what we call an insured mortgage is it carries a lower interest rate because it is able to participate in NHA loans, which are National Housing Act loans, and the MBS, mortgage-backed securities market. And so essentially what happens is in order to participate in those capital markets to get cheap money, all the mortgages that are sold in that marketplace all have to be insured and guaranteed by the government of Canada or one of the private mortgage insurers, Genworth Canada or Canada Guarantee. So what happens is those mortgages, because they're insured and because they're able to participate in this very safe capital market, carry a lower interest rate. And this is pre-COVID, okay? The uninsurable mortgages need more expensive capital because you're not able to participate in that MBS market and the NHA market. Those are what we characterize as uninsurable mortgages, and they carry a small premium. In general, that premium varies between 15 to 25 basis points. So for example, if we were doing a high ratio mortgage today, and you asked me the best 5-year fix, so high ratio is less than 20% down payment where the borrower pays insurance, we're looking at about 2.49, 2.44% 5-year fix. If we go for an uninsurable mortgage, that rate is about 2.69 to 2.74.
Interesting. You know, you struck on something which I'm going to move from individuals to the system as a whole, because, you know, again, I find mortgage talks often very tedious online. That when you
Sorry.
Well,
I'm surprised anybody's still listening.
No, not this one. This one I'm actually finding very engaging. And the reason is, Chris, because I find so much of what people want sometimes hear are like, okay, what's a rate? Okay, what's a variable? What's a fixed? Who cares? We're in a crisis. I want to understand how the system works. And I know that that's a hard thing for us as individuals to answer. We don't regularly deal with systemic risk. But the reason I'm asking this question, and the reason I'm striving to really understand what are the effects of COVID, is because, and I'll share this with you, and you may not be aware of this, I have had 2 banks, major banks of the top 5. Actually, I'll tell you which ones they were. They were actually 3. We've had TD, Scotia, and BMO on separate projects announced to us that even though they had extended commitments, they were not proceeding forward with commercial lending for retail. Not for multi-res, not for multi-res. Everyone's going to need to live somewhere. That's fine. That still gets CMHC insurance no matter how big the unit. For retail and for office, there is no further lending that is happening from these major banks. And the reason for that goes back to something, and I'm projecting here. This isn't my area of expertise, but you know, I'm trying to understand the market myself. But the reason for that has to do with those technical terms that you talked about, which is the MBS, the mortgage-backed security. With everyone's permission, I'm going to back up for a second. Effectively, when a bank does a mortgage, they try to get the money back from that mortgage immediately. And the way they do it is they take like sorts of mortgages, they bundle them together, and they sell them to the markets. And if they are CMHC or Genworth or anything else approved, it's very easy to sell to the markets. In fact, the Canadian government itself during the COVID crisis has been buying billions of dollars of these mortgages back from the bank because they're already on the hook for them.
150 billion, and that was what was announced at the last Bank of Canada meeting. There was no change to rate, but significantly, and lost on most people, was that they were buying back $150 billion worth of mortgage debt in these mortgage-backed securities.
Which is critical, because what they're doing is they're saying to the bank, hey, you have all this debt on your books. We're going to give you the cash in lieu of the debts so that you are capitalized sufficiently to go ahead and lend to others. And there's no downside to Canadians, because Canadians are already on the hook for these mortgages. They are already CMHC or Genworth approved or anything else. So there's not going to be any greater loss for Canadians, but it does put money in the bank's hands. Then the bank says, okay, I have money in hand. Where am I going to lend? And it looks to me, based on what I'm seeing in the commercial markets, again, I appreciate you're not commercial, but we're talking just systemically, that they have made a decision to only invest in residential real estates, because that's the only thing that they know we're going to be coming out of and that people are going to need. And everything else is being shut down and deprived of capital, even though they may have it on their books. And this is the advantage of the MBS market for the mortgages. Now, I know I've said a lot there, I may be wrong. Don't take this as gospel. This isn't my area. But this is what I'm seeing out there. I'd love to hear what you have to
Yeah.
say.
Yeah, I've experienced the same, Mark. And I mean, this is not a Bay Street crisis, not like 2008. You know, we called it the Wall Street crisis. Here, we'll give it a Canadian context. It's not a Bay Street crisis. This is a Main Street crisis that's evolving out of the health crisis. And so everybody on this call appreciates and understands how small business is being affected. And so if you're a commercial lender, you have to keep in mind commercial mortgages are underwritten very, very differently than residential. On residential, the decision to lend is based on the personal covenant of a borrower, right? So the personal covenant is their ability to earn income to pay back. When it comes to commercial financing, commercial properties are looked at as an income producing or revenue producing asset. And so where does the revenue come from that asset? It comes from the leases, right? The tenants. What income does a property on Yonge Street, on the Danforth, on Bloor Street, what income is it able to generate to cover its liabilities? And so and it's a very real possibility, we don't know how bad it's going to be. We don't know how to assess the risk right now. A commercial lender doesn't know how to assess the risk right now. So why would they want to expose themselves to lend money with so much systemic risk at the moment that storefronts are going to be empty, that tenants aren't going to be able to pay? And, you know, I sit on the Business Improvement Association of the Danforth, and here there's a very strong community push to have relief on commercial lease payments so that small business can survive. So if commercial leases are being forgiven or whatever is being fought for, how the heck are commercial mortgages going to be paid? That is a huge, huge risk for lenders.
Interesting. Yeah, I'm seeing that as well in my legal practice. I'm actually working through many of the, I mean, of course, it's a huge opportunity for private lending, but you know, the systemic risks that the banks are recognizing, I think, are real. What's interesting is that I actually play with some commercial players, some very large ones, and the people who are going to be taking massive hits to their balance sheet with no recompense from the government are going to be the biggest of us for the first time in history. It's going to be the Oxfords, it's going to be the Bentall Kennedys, it's going to be, these places are losing rent and they're not going to get it back. What's more, when we emerge from COVID, we are going to have a dynamic where people are used to online shopping, where people have recognized that perhaps they don't need the actual volume of space that they've taken up in their buildings as people have moved remote. There is going to be a seismic shift in how commercial real estate is used. And I think what you're seeing in the commercial market is banks who do not any longer have confidence that the existing paradigm that we went into COVID with is what we're going to emerge from. And so the mortgage market is a tailing indicator, or a trailing indicator, excuse me. No, not trailing, preceding indicator.
Leading it.
It is a leading indicator of a trend that I think we are going to all live through as real estate agents and try to make our peace with as the commercial market changes drastically. Again, I think there'll be very little change to the residential market. Normal immigration and influx into the Canadian market means that there's demand for products. People don't stop renting when these things happen. We always need a place to live. But people don't always need a place like Walmart to buy goods. There's Amazon now. And people don't always need a tower to congregate. There's Zoom now. And how that effect is going to translate into systemic risk of the deployed assets that we have available, well, I think the banks are trying to get ahead of that in their decision to kind of shut down their exposure to risk by lending. And I'm very excited. Excited is the wrong word. I'm scared. But at the same time, I also understand that reality kind of hits us in the face whether you like it or not. So I'm keeping my eyes very open to seeing what happens in that regard.
Yeah, I think you've characterized it perfectly, Mark, and I agree with, you know, all these indicators. There's just too much unknown, too much risk there, and listen, if you're sitting on the money and ultimately responsible for putting out money, Would you be lending on commercial? I don't know. Even private lenders. I mean, this conversation goes beyond. So we've talked about residential mortgage lenders that have the privilege and the opportunity to participate in the MBS and NHA programs. We've talked about commercial, but I've had 2 commitments be pulled for private financing as well in March, and it was committed. It was at the lawyer's office, signed, sealed, and delivered. This is more contractual mortgage business 101. You don't pull a commitment at the lawyer's office, and it just the rug got pulled out from under us, and everybody ran. And a lot of the private mortgage lenders utilize leverage in order to expand so they don't have the opportunity to raise capital from direct investors. But one way that they increase their lending capabilities is by leverage. They have an operating line of credit, essentially. So if you've extended your line of credit and April 1st hits and only 25% of your or 75% of your portfolio makes a mortgage payment, you're SOL. You're underwater. You don't have enough revenue to cover operating expense and your line of credit liability.
Yeah. Chris, I'm going to ask you one last question, then I'm going to open it up to everyone, just because everyone's been very generous with their time, as they always are. But I know that you run a MIC. I'd like you to explain what a MIC is. But more importantly, I want to ask a question, which is, there are people who are now sitting on pools of capital, scared to death. They're in gold or money markets at this point because they don't want to lose their shirt. They're not sophisticated investors ready to invest along Lloyd Blankstein or whoever it is. And they are saying, all right, I'm going to go into the only security that I know, which is private residential. When someone comes to you and says, hey, what type of return can I get through, say, a MIC investment? And what is the security that I have? How do you answer that in today's COVID market? And start, please, with explaining what a MIC is. I'm sorry, I've been blasé here, but I'm relying on your brain, not mine today.
Sure.
Go for it.
All right, no problem. Before we engage in this conversation, I just want to make sure that I highlight, and it goes on record, that this conversation now involves securities and investment. Neither Mark Morris or myself are soliciting any investment in securities, and our regulator would be happy that we lead off that way, okay? But very briefly, a MIC is a vehicle that's used to invest in private mortgages. And it's a very simple concept. A corporation is formed. Individual investors buy shares in that corporation. That's how we raise capital, okay? That capital then gets used to invest in a pool of mortgages. That pool is typically managed by the fund manager or the MIC manager. They select the style, type of mortgages, the type of risk that get taken on. And there are a couple of unique things about a MIC. A MIC is actually a corporation defined in the Income Tax Act. If you want to find more information about it, it's actually in the Canadian Income Tax Act, Section 130. And what's unique about it as a corporation is that it's a flow-through corporation. So the corporation itself is not allowed to hold any revenue. So as interest income comes in, it covers expenses for operation. At the end of the year, all of the profit or revenue, net revenue, must be distributed out of the corporation to the shareholders, okay? So it's a very popular vehicle for private mortgage investment and allows you to really spread your risk out over an entire portfolio of mortgages that's managed for you. Because the alternative is to invest one-on-one directly in a private mortgage, and that has a number of serious problems. Number one, you might not be set up to properly assess that risk, manage it, and then also all your risk, all your eggs are in one basket. So if that one borrower doesn't pay, now you're SOL, right? So the MIC allows you to spread it around and have it be professionally managed for you. Any questions about that, Mark? Does that make sense?
No, that was well described. I mean, what I guess it is really like a REIT in the respect of passing income through, but for private mortgages.
That's correct. That's correct. That's a good way to characterize it. It is TFSA, RRSP, RESP eligible, which also makes it an interesting option for investors. In terms of rate of return, I mean, each MIC is set up differently. There are many different shapes and sizes of MICs. Some are publicly traded, and some are fully private. Like mine is just friends, families, and close business associates. So they're different styles, and some invest in commercial, some invest in land development, and some do just private seconds. So in general, though, most MICs, and there's been a real explosion of MICs over the last 2 years or so, as lending has become tighter and tighter from market lenders. There's been a need for private capital. So we've seen a real proliferation of MICs. A lot of them participate in residential. I'll discuss this in terms of residential financing. And they would provide mortgages, first, second, third mortgages, and interest rates on those types of loans depend on the borrower's covenant, again, credit and income of that borrower, and the underlying security. Now, when it comes to private financing, the majority of the financing is based on how secure the capital is, right? So, or how secure the security is, the underlying real estate, I should say. And so we're looking at things like loan to value. Now, returns for MICs can vary anywhere between 6 to 9% in the marketplace is kind of what I'm seeing. And those returns really depend on how efficiently they're run, how much leverage is being used within the MIC, and how successful the fund manager is in selecting and managing that portfolio of mortgages to make sure that they're all performing. And the major concern now, I know you want to say something, Mark, is making sure that the mortgages selected within that MIC are performing.
Right. And so to be clear then, let's bring this to COVID, because that's after all what this talk is about. Do you find that people are flooding monies into MICs at present time given market uncertainty, or is it seen as a risky investment in the present environment?
It is a risky investment like all investments. I'm not seeing at this time a flooding. There is the opportunity cost for capital, and you have to frame this depending on what the profile of the investor is. Because if you're an investor that was participating in securities and have now lost 30% of your overall market value of your portfolio, are you likely to pull money out to invest in something else, or are you going to hold on, right? Versus people who have dry powder, if you will, looking at how to deploy their capital at this time. And I think most people, I mean, the number of phone calls, just as an anecdote, number of phone calls I got from two things I got when the crisis hit. People who wanted to defer their mortgage payments, and people who wanted to access capital to take advantage of a once in a lifetime opportunity to invest in stocks.
Right, of course.
Right. So I think there's more upside in capital in equities markets. There's tremendous volatility in equity markets. We don't know the timeline, but we all expect that unless these big corporations go under, we're going to get back to, hopefully, maybe that's wishful thinking now, but we will get back to where we were pre-COVID.
Yeah, fair.
But the MIC presents an interesting opportunity with exposure to Canadian real estate, which traditionally is very safe. I mean, we all participate in one way or another in real estate. We all make a living off of it, and we all know the numbers. And so, for example, my MIC is focused on second mortgages in the GTA, and I'm not too worried about price decline at the moment. If this prolongs, yes, I will be worried, but so far the metrics coming out show that volume is way down. That's to be expected, but their prices haven't really declined all that much.
Yeah, I'm finding the same thing actually. Across all the agreements of purchase and sale that enter into our office, I'm finding that it is a simple economics 101 where supply still meets demand at the same point along the curve. The curve is just much smaller. Effectively, what we're talking about is no change in price, just change in volume. again, who knows how long that exists, but you're right.
Yeah.
I think that there's security in that, and in the stalwart way that the Toronto market, the GTA market, is performing presently, for sure. Chris, with your permission, just because we have 10 minutes to the end of our, I'm going to open up for questions. I know we've covered a lot of advanced topics here today, guys, and I know this has been a bit different than normal mortgage discussions, but I really kind of wanted to graze what's happening with our industry. Hopefully you've gotten a lot out of it. Please ask your questions, and if anything was unclear, I'm sure Chris would love to explain it. Again, just for those people who came in afterwards, Chris, Bart, who's presently on the call as well, Andrea Jolly and Denise, Sean Stillman, Elon Weintraub. These are the mortgage agents in Toronto who, in my experience, make a tangible difference because they know what is going on. They have practiced and they are honorable people. And you cannot emphasize that enough when it comes to mortgages. There are a lot of people, similar to all industries, but in the mortgage market is what we're talking about. There are a lot of people in this field who are quite disreputable and don't help their clients the way that the people who I've mentioned do. Chris is one of those, and so having his time and the opportunity to ask him questions is valuable in that regard. So I'm going to open it up. Anybody have any questions? Just unmute yourself and please ask away.
Hi there. It's a really great meeting. Sorry, Sandy here.
Hey, Sandy.
Hi, Sandy.
Are you assisting in second mortgages just as fillers to get deals closed where buyers can't close? There are an awful lot of people who got sued for not closing in 2017 because they couldn't come up with the funds. Are you providing interim funding just for that? I'm talking about people that have temporarily lost their job. They had great jobs before, and you know that they will probably get rehired.
Yeah, great question, Sandy. That's an excellent question. Private lenders are very sheepish. And so there are solutions that can be arranged, especially, we can get creative with things like additional collateral, right? So collateralizing a private mortgage on maybe a parent's property, if there's the willingness to have support. But if it's, for example, a purchaser, first-time home buyers who are buying with 10% down payment and got laid off by Air Canada, that's going to be a problem, right? So the fundamentals of private lending and the prudence still needs to be there. In terms of providing private second mortgages, for example, if an A-type lender, the first mortgage lender, is still participating, but wants to pull back on the amount and they're short 5%, then there are solutions there for that. So it really depends on the circumstances, and there is private capital available. There's always opportunity. So I would invite anybody who has a situation like that to be in touch, and we'll share my contact information afterwards.
Perfect. That's exactly the situation that I was thinking, that I'm telling people. Beg, borrow, or steal it from your relatives, but try and find the money, because the lawsuit will cripple you and you'll lose your... A lot of times they're bringing money from their existing property anyway into the second purchase. Right. So at least there's equity there. But that's what I'm telling them is do anything rather than get sued, because the largest the largest judgment to date was $652,000 against a 1.9 purchase.
Wow.
Yeah.
It's scary stuff. And Mark, you may have some comments about that. What the knock-on effect is if somebody doesn't close on your house and you need the down payment for the subsequent purchase. What does that look like from a legal perspective?
Yeah, listen, I'm not going to today because I think we've addressed that actually at length in previous discussions and threads. And I'd like to just kind of keep it focused on mortgages, but obviously you have an obligation to close. And my growing take, just in a one sentence line, is that if you are residential and it's not a tenant that's stopping vacant possession, there's very little chance of using COVID as an out. If you're in the commercial markets and banks are no longer lending, or alternatively, if there are substantive matters that need to be addressed in municipality prior to close or anything else, all of those things are much more subject to frustrated contract act or anything else. And it's a case-by-case basis, certainly subject for another discussion, one that everyone has every single day of the week now around here, because that's kind of the environment we're in. But yeah. Sandy, that's a great question, and thank you, Chris, for answering it. Chris, can I also ask you, if you don't mind, in the chat box, can you just leave everyone, or say it verbally, because I don't think chat comes up on the record, just tell people what your contact details are. Some people are asking.
Yeah, no worries. I'll fill it in here. And I would invite anybody to send me a quick email. I'm very big on supporting realtors, because I find there's a real, unless you have a good mortgage professional, and for anybody who has a great mortgage professional, stick with them, right? There should be a lot of trust there. But if you don't have somebody that's trusted on your team, I invite you to get in touch, and I have information that I share regularly with realtors to keep them appraised of developments and support them with their clients.
Terrific. All right, anyone else have another question? Last chance for the esteemed Chris Mulder Esquire. Well, I guess not Esquire.
Oh, you're so wrong,
but it sounds so good when you say that at the end of the sentence. Look at that, guys. We made him blush. Someone's got to ask one more question.
Can you tell that?
Yeah, I see the blush. Nope. All right, guys. So like always, I want to thank you. Chris, I've found this an engaging discussion. I've learned a lot, which is the critical component. I think others have too. This was awesome. I'd invite you back anytime. I just note that you're Christopher Mulder, C. Mulder at tridacmortgage.com. Tridac is TRIDAC mortgage, MORTGAGE.com. And C. Mulder is CMOLDER. But I thank you so much for coming out today. This was awesome. We'll invite you back, as I said. And guys, everyone who spent the hour with us, and all the people who are going to be reviewing this after I post it, thank you for your time. You make this forum what it is. I'm incredibly grateful for all of the efforts that you put into this. And yeah, let's just keep doing this and keep learning.
You said it all. Thank you so much for having me on. I look forward to the next one. And thanks for everybody for their attention.